Hello everybody, welcome to TraderMerlin Show. It is your Wednesday. Happy hump day. Sorry for the late start. I'm wrapped up in the England-Denmark game here. I was kind of, who do you cheer for in this game? I was going for Denmark because of what happened to Christensen, but England, I mean, come on, I haven't been there in over 60 years. Some good stuff out there. Anyway, for those who know what I'm talking about, it's soccer day. We got a good game happening. I'll probably be cheering in the middle of the show as I have on my screen. I'm streaming all this and watching the game right now. Anyway, hope you had a great trading session out there. Some good moves for some of the indexes. It's funny how we have some of the others going the opposite direction, like the Russell 2000, although it paired some of the losses. Today's show, I'm going to talk about a little bit about yields and bonds. And I came up with a cool little graphic over here. It just says, where did inflation go? As you guys know, my feeling is there is definitely some inflationary pressure out there, and it's probably going to rear its ugly head and get a little bit worse. But we saw some things happen recently which kind of maybe subdued a lot of that talk track. So it'll be interesting to see how it all pans out going forward. But anyway, welcome everybody. I see we got a big group with us today. I won't give a shout out to everybody, but thanks for joining me. So the question for today came in from a gentleman named Lee, who actually, there were a couple questions similar on the topic, but I put Lee's up here. It says, what do you make of the bond yield dropping, no inflation with a question mark after it? And I got to look, you know what? That's a great question. So first, let me show you the 10-year. Now, this is the actual futures product. We talked about this the other day. And so, it had a pretty big spike, and it did break above some most recent highs. But what's most interesting is if you look at this chart, how we broke it yesterday. Obviously, it was a huge move yesterday. Today, some nice follow-through, but it doesn't really have any great supply zones or anything to look at until maybe getting up to about this 134.30 mark on the 10-year futures contract. Now, of course, if we look at the bond picture, or the yield chart, let me bring that one up. Here's your yield chart of it. And you can see that it has been drifting down. And, does this mean it's now officially on a downtrend? In my mind, yes. Since it's been peaking in March, it's really just been drifting lower and lower and lower and lower. What was kind of disturbing, at least if you're heavy in the bond markets, is how quickly that yield has been dropping. So all of a sudden, we saw it's gone from 160 to 132 right now. That's almost 30 basis points, which is a pretty significant drop in about a week and a half. To answer your question, Gary, can the inflation data be manipulated? Abso-friggin-lutely. And it's not a question, and this is my personal take for you out there, Gary and others. I think some others will agree with this. It's not a question of if it's manipulated. It's just to the extent that it's being manipulated. I firmly believe that all of the data that you and I get is completely manipulated. We actually, John O'Donnell would remember, but he got a guy on Power Trading Radio one time, and the guy worked for the Bureau of Labor Statistics, formerly worked for them. And I asked the question, not expecting him to answer the way that he did, and I said, if you guys have all this data, do you ever manipulate it or tweak it to fit any objective? And he goes, yes, we do. We fit it to fit whatever the political objective is. And I thought, oh, well, then how am I even asked him, I said, how am I supposed to respond to the data that I see, or how am I supposed to act on that information? So I thought it was kind of interesting to hear him say that. It just echoed what I believe and what I think most of you believe, which is that the data is absolutely cooked. And unfortunately, we have to base our investment decisions off of that data. So we'll look at some of that data here going forward. So a big drop, obviously, in that 10-year. Now, it's still at high levels compared to what it was at a year ago, but granted, it is definitely selling off and giving back some gains. Now, for those that aren't real big on macroeconomics, this is what a lot of the pundits are talking about, saying, because you have this yield falling so aggressively, that is really saying, from the institutional perspective, that inflation is not a concern going forward. Well, look, I think it's just a pullback on a bigger move. If you look at the move that happened from August or late July of last year to where it peaked at, I'll even draw some lines on this one. You've got it from there to there. That 10-year rallied up about, this is 254%. All right, nice. And right now we're having a pullback to the extent of where we are right now of a decline of 25%. I don't think that this is the end all. I don't think that this is a huge pullback. I do certainly think that it's raising some eyebrows, because if inflation is there and aggressive as I believe it is, then you really shouldn't be seeing this 10-year drop like this. It should actually be moving to the upside. So what are some of the factors for this? One of the things that came up at the at the meeting minutes today was, and of course you guys know in the June meeting, if there was a mid-June meeting, they have these called the meeting minutes where basically they document what they were saying, what the thoughts were on various issues. And one of the points was they felt that there was a need for them to potentially start to cut back on their purchases if the data reflected it. It's not reflecting it right now, but some of their mindsets were changed that we could see potentially a tapering of spending. And remember, they're buying $80 billion worth of treasuries and $40 billion worth of mortgage-backed securities a month, which is helping prop things up and keep rates low. By watching them backpedal a little bit here and say that they might start that purchase, that obviously has an impact on the bond market, but typically that would do exactly what it's doing here. If they keep purchases up, then that should push these yields down, right? Because you're driving price up. What else do I got on that one? So the other piece that I thought was interesting from the meeting minutes today was they were talking, of course, about inflation. And, of course, Lee's question was about, is there inflation with regards to this data? They used the word transitory in the meeting minutes a few times, whereas during the speech that Powell gave, he removed all comments about transitory. Now, let's look at some of those commodities because I don't have all of them here. I wish I had. I think I might actually make a screener that just has commodities that make up CPI, PPI, and the GDX the GD price index. I always forget the damn initial. This is an announcement that's coming out next week. For those that don't know, next Tuesday and Wednesday, we have CPI and PPI numbers coming out. So that inflation discussion, I think will get a little bit more heated up. But you look what happened in lumber. Obviously, that's the biggest retracement of any inflationary move that I've seen so far in the commodities market. But you look at crude oil. Crude oil had another nice pullback today, down 1.62%. You look over to things like... let's go down here to soybean futures, right? Certainly, they had a big move up. If you go back to August, that same period of time that we looked at the bonds rally so aggressively, I'll do that same measured move, right? From the bottom to the peak there, you're looking about 93% increase in the price of soybeans. You look over at something like, not the 10-year bond. Let's go. I thought I had corn on here. Where'd my corn chart go? Did I lose my corn? I lost my corn. Oh, no, there it is. You see. Look at something like corn going back in that exact same period of time, you're looking at an increase in corn about 139%. So they're still up. Even if I adjust it to where we are today, in less than a year, you're up 76%. So I don't know if I would call this transitory. However, that's what the Fed is labeling it. So we do have, obviously, with the 10-year doing what it's doing and selling off rather sharply, I don't believe that this is the new trend and you're going to see all of a sudden the 10-year continue to slide. I think it'll come back down, maybe to 110. You can see there's a little area of demand right around 110 where, I expect it to maybe bounce off of. But I think if we look at the longer term picture, inflation is still there. I can go look at different economic measurements like PPI or CPI, and you see that those two have been very high compared to normal. They've come down a little bit, but it's still way higher than normal. So to me, the question from Lee, is there no inflation? No, I disagree with that. I think that this is just a little bit of a pullback in the overall uptrend, and I think this has a lot to do with the Fed's comments about tapering, about yields, and what they called reducing asset purchases in the meeting minutes. So to me, that's what the big news of all this is. Now remember, they said there was one other comment they made. It was substantial further progress was the word that they use now and introduced into it. And they said once we get substantial further progress with regards to economic data meeting their objectives, then they'll start to taper. Noteworthy in this, though, was the several of the members of the FOMC were saying that they foresaw rate increases happening much sooner than expected. Of course, we saw that with the dot plot, and that dot plot kind of outlining that it could happen much, much sooner than before. All right, triggers to stop the economies. Thanks, Brendan. Let's see. What else do I got here? Any legit comments? No. Brendan says, I don't use CPI. I don't use it either, but I like to look at it. And again, it goes back to my trading rules, which are ignore the news, but listen to every word of it. Because if there's any trend forming, it may start to form on that data, even though it's manipulated. It's easy to manipulate data for 1 or 2 periods, but once you start to get in that longer term time frame, could be much more challenging to manipulate that data going forward. Now, if anybody is waiting to watch the New England game, or not to England, the England-Denmark game. I may do a spoiler. If you're afraid of spoiler alerts, then type in no, because right now, oh my god. Oh, well, I won't ruin it for anybody. Son of a biscuit. Game's over, folks. Oh, what a good one. Great ending to it. I guess I gotta turn this one off because I'm gonna be sitting there glued to this thing. Can't believe that just happened. But we have a victor, so there is a final for the Euro Cup. Italy versus. I won't spoil it for you because I'm sure some of you might want to watch that. All right, let me remove that from my screen. All right. So to answer these questions and to get back to the topic of where did inflation go? I don't think it went anywhere. I think it's still there. I think it's tapered their thought track on a little bit simply because you have the bonds. And I think this is to make everybody feel warm and fuzzy about our markets. And of course, if we continue to see this 10-year drop like this, that's great for markets. If you notice on this yield curve, before we look at this yield curve, I want you to look at the chart on the right. So the chart on the right is the S&P 500. This is the market. Chart on the left is the yield curve. This goes all the way back into 2000. And just to put it into perspective, look right here from 2000 to 2003. That was a 50% decline in the equity markets. 50%. And that was, people were like, oh my God, this is the end of the world. This is apocalyptic. It was horrible. Same thing happened back here from 2007 to 2009. I think it was 58% slide. And does something look wrong here? I mean, this looks completely broken. It looks so crazy the way this market is just ripped to the upside from 666 to where we are today, 4,343. Absolutely crazy. Anyway, I'll show you just the last few months. Unfortunately, I can't zoom in on the price chart on the right-hand side, but I'm going to start with where we're at today. Notice that yield curve. This is a fairly normal yield curve, but the long end, the on the left side of your screen, there's that chart. That's the yield curve. If you notice that to the right of that, that's the long end. That's the 30-year. You notice it's come down over the past few months, and that's, of course, what the Treasury or the Fed has been trying to do is say, hey, let's put pressure to bring that thing down. Even though they don't control the long end, they can certainly influence it with their purchases of bonds and mortgage-backed securities, which is what they have been doing. Let's see. So, no, I don't think that inflation is gone. I think inflation is still here. I think it's just I think honestly it'll be much more talked about once we get into next week's trading session because of the big economic data. You have multiple things next week that are really key towards driving prices. On Tuesday, Wednesday, again, you have CPI on Tuesday. Wednesday, you have PPI. And then on Friday, you have retail sales, which has been dropping more than normal. We're at negative 1.3% on retail sales right now. So who are the diving finals? I haven't watched the diving finals. I've been watching some of the trials. I can't wait. I'm a huge Olympics fan. I may have to cancel the show, the entire Olympics, just so I can watch the Olympics because they're going on during the show. I'm kidding. I'll still do the show. Yes, it was England for those again. It'll be Italy versus England. I was really hoping for Denmark after what happened to Christensen, that soccer player. If you guys got a chance to just see that, I actually went and watched that match, and boy, what a gut-wrenching moment that was when Christensen went down and literally he was dead on the field and he came back. Pretty crazy. All right, let's see. Patrick says, Merlin, do we just look to Fed Powell speak to understand when they are slowing their buying of bonds and mortgage-backed securities? Yes. It's great that you asked that one because I'm fortunate enough to have lived through a few of these Fed chairmans, and if you go back to Greenspan, unfortunately, when Volcker was around, I really wasn't into the markets, at least didn't really pay attention to that degree. If you look at what Greenspan did, he wouldn't telegraph his punches. He wouldn't tell you what he was doing. They would just kind of come out and be like, you're just stuck with that. You're like, oh, well, here we are. This is what's going to happen. And then it's gotten progressively more transparent with Bernanke and then Yellen. And now with Powell, I mean, he basically made it very clear, especially in the meeting minutes, that they would make it very public knowledge before they started to taper at all with regard to their spending. They would make that very clear to everybody and make that announcement. So I'm not sure which camp I like better. I like the transparency, but part of me likes some surprises. I remember there was a 50 basis point cut that Greenspan did in the middle of a trading session one day back, I think it was 2001. It was one of the maybe it was before that, 2000. One of the craziest trading days I've ever been a part of with regards to the charts just completely changing their perspective as prices went absolutely haywire. When nobody expects it, you get really big moves. When it's totally telegraphed, you get muted moves, which I think that's what the Fed wants. They don't want the crazy reaction, so they're telegraphing everything. So it's kind of unfortunate, but yes, we have to just watch what Powell says and kind of gain. There's, how we look for trends in price action? So if I'm looking at supply zones and demand zones, you'll notice that their talk track will actually define supply and demand zones with regards to where they're looking to turn, where they're looking to step up buying or quit buying. And their talk track, just some of the words they use, can recur over and over again, giving you clues as to what they may be doing. So it's stupid, but that's just unfortunately the way that it is. And in the future, who knows how it's going to change. But one thing I love about the markets is they are constantly evolving. They're always changing. And just when you think you figured something out, that piece changes and another one starts up, or maybe even a whole new market begins. So it's one of those things that you'll do forever and just always be a student of the markets learning. So Lee, that's my answer to your inflation question. I don't think it went anywhere. I think that the bond yield is an aberration. I think that you're going to see it actually rally back up here, and we'll end up moving back higher and higher and higher. All right, let me go to, there were a couple questions. One I don't really know the answer to, and that's this one. I'll run this one for less because he was the first one in the room today, so I will read this one. It says, do algorithms run all night, or do they stop at the end of regular trading hours? If they run, how might we see their footprint during the Globex trading hours? Great question. I don't know for a fact what the algorithms are doing. Remember, there's many different types of algorithms with different objectives, and they're going to be proprietary to each of these different investment firms. My assumption would be that they are running during after-hour session. If you have the proverbial goose that lays the golden egg, some software program that you basically just turn on and let it run, set some parameters for it, and it does all the work, why not let that thing run in the after hours? Now, regarding what you might look for, you're still looking for, unless you're an Online Trading Academy graduate. So when you go through, there's the odds enhancers, those are criteria that you'd be looking for to help substantiate a level. So I won't run through all those because obviously that's not for me to do. That's for Online Trading Academy. But if you look at the odds enhancers, to me, that helps you determine the quality of a zone that has been formed, whether it's regular hours or after hours trading. So I still would be using the odds enhancers. The big challenge is it's a given that in the after hour session volume is incredibly low. It's much lower than normal. So for me personally, it takes away some of the validity of the zone, but it's still a zone, right? It still may have some weight. So if I have a zone that was formed in the Globex session, let's say it's 2 o'clock in the morning, and I see a level that's formed on the S&P futures. And during that period of time, that level was formed. Maybe there was, let's say, 200 transactions, 200 volume of futures contracts traded. If the regular market's open and I'm using that as a demand zone, and all of a sudden price comes ripping down to it, just a couple hundred futures share order or futures contract order could rip right through that level. So again, I'm looking for ones that are going to have big, substantial people buying at those, and they generally don't form during the Globex session. But not silver. You're off the silver train? I will look at that one. I'm still long gold. I'm out of silver myself, but I actually was debating buying some. In case of market crash, and you're sleeping, I guess. Yes, and Patrick, so my assumption would be that they're gonna outside of regular market hours, they're gonna change some of the configurations of the algo. And my guess would be that's all time based. So as soon as that market closes, in the code, it switches and says, okay, you can no longer trade 1,000 contracts at a time. You're trading, 5. So it reduces the threat, because if you have a system that gets triggered, let's say, for example, you've got an algo that's trading 500 contracts at a time, and it hits the after-hours session, and maybe one of those levels are hit. You send 500 contracts to sell in the after-hours, that market's plummeting. It's going straight down. If you send it during the regular market hours, it's going to go down, but nowhere near as much. So I'm sure they curtail the quantity of contracts in these algorithms. All right, let's see. So Les, that's the only one I really know. I mean, I don't know for a fact if they're trading 24 hours. My assumption would be yes. Okay, last one, and then what questions do you guys have for me today? I had that one quick question about inflation, interest rates. Not going away. We've still got inflation. Here's one from Jimenez, and I think that this kind of ties into our current market situation, because we have, again, one of the most overheated housing markets ever, 14% year-over-year growth, which is almost unprecedented. Jimenez says, with the mortgage forbearance officially expired on June 30th with no extension, will there be more foreclosures and houses that will go on the market? I'm looking to buy, but just wondering if I should wait to see what happens. Oh, boy, I tell you what, that is an extremely tough one. I agree with you that, well, I don't know if you were making this statement, but I believe that you will see more foreclosures coming onto the market. But remember, those take time. I mean, you're talking months for a foreclosure to actually get to auction status and being sold on the county steps. I'll be looking. I'll be able to tell you because I look at a lot of auctions for real estate. I was looking at one up in, it wasn't Modesto, Stockton. Was it Stockton? Oh, God, I forgot. It was NorCal. It was right with just about by Sacramento, but a little bit west. I want to say Stockton, but there was like 70 properties on this thing, and I was like, wow, they were $1 million properties too, and not one of them went to market. They all were just, either delayed auctions or the owner made the payments for their property taxes, etc. But if you look at forbearance, I have a couple friends right now who it kind of embarrasses me that they're like totally using forbearance. They're fully using it. And for me, I'm like, just pay your mortgage. Just pay your mortgage. And there's no need for them to be doing it. They're just trying to take advantage of the system right now. There are other people out there who are in dire need of that forbearance. Now, of course, you look at the unemployment numbers, you look at the job data. Look, there's jobs out there. So if you got a mortgage, you should be able to pay for it by getting a job. It's just it's kind of changed a lot of people's perspectives of working. I have a couple friends that aren't back at work yet. They don't really intend to. It's like, well, why? And well, the added unemployment benefits was incentive for them to stay unemployed, and now they're just kind of used to it. I don't know. I'm for one that if you've got a house, you better be making those payments and continue to do so. So I do think there will be people that once the forbearance disappears, they're going to struggle. We can keep our eyes on mortgage delinquencies, which will probably rise, be my guess. The question for you, Jimenez, is does it rise enough that it actually ends up impacting and coming to the housing market? This could be 3-4 months before we start to see a flood of properties hitting the market in foreclosure. So I think you got a little bit of time to wait. The good news, if you are thinking about buying, is you have you have the 10 years sliding, which means that those 30-year fixed mortgages will probably be even better. As I mentioned yesterday, I got a notice for under 2% for a 15-year, which was, I just thought that was absolutely crazy. All right, what else do I got here? It's okay. I like when you guys ask questions that it's difficult for me to answer. I mean, I certainly do not know everything, nor do I claim to. Brendan says, how awesome is Ethereum? It's interesting hearing the talk track from a lot of industry analysts. I think it was Goldman Sachs or something. They said that Ethereum has greater potential as a store of value than Bitcoin, which I thought was rather interesting. If you dig deeper into it, you'll learn that there's a couple others out there that are pretty good. They could actually be Ethereum killers. They just don't have the market acceptance right now, but the infrastructure and back-end technology there to make them beat Ethereum. But yes, I love Ethereum. Still my number 2 holding, but it's gaining. It might actually pass my number 1 holding here soon. All right. You did it back in your claim and risky and heavy export foreign countries. Okay. What else do I have? What other questions do you guys have for me? I had my algo question. I only had 3 questions come in last night, which is usually it's a little bit light. I had the yield drop, which bonds. I had the mortgage forbearance. Oh, by the way, Les, you'll be happy to know I had to do a complete uninstall, clear everything out, and then to reinstall my my options chain now works, which is great because I really want to. They're going to be getting back to some weekly options here with some of these big moves. So yes, I may actually do it tomorrow if I have time to do kind of that 1% strategy. Not really strategy, just but 1% perspective of selling options. So I'll look to that one for you mañana if I can. Let's see. Let's look at our overall markets. Today was actually kind of interesting, especially when you look at the rate of decline of something like the Russell, which has had a pretty aggressive 3-day drop. Still not past those lows that we saw in mid-July, but moving quickly compared to what you saw with the S&P 500, which was all-time high yet again, up 0.41%, looking great, no signs of relief. NASDAQ was kind of interesting today. It actually had a little volatility, was down for a little bit on the day, rallied back up and came back off its highs. So you do have it's not really a bearish pattern. Someone asked me if this was a shooting star. I wouldn't call this pattern on the NASDAQ right now a shooting star. But, we'll keep an eye on it. Last time we had a hesitation pattern. I went short, got stopped out within minutes of that one. It was a very quick transition, and luckily I'm out of that one. But maybe I'll go short it again because I think we're definitely due for a pullback here at some point. Let's see. What was Ethereum's competition? I would say the two main are going to be Cardano and I think Polkadot. I think those are probably the two biggest competition for at this point. If you look at the scalability and transactions, I still think EOS has a shot, but for some reason their development team just hasn't been able to push it. There's a lot of other technologies out there. When you look at hash graphs, you look at directed acyclic graphs or tangles and things like that, which could augment this scalability. Right now, the big question for Ethereum is scalability. Bitcoin is not about scalability because it's Bitcoin. They don't really have to worry about scalability. But when you look at transactions, then you have to have scalability. And given the fact that Ethereum can do about 15 transactions per second, just doesn't make it anywhere near as competitive as some of these others that are doing over 1,000 transactions per second. Yeah, Solana is pretty good as well. I would say that's a different third. A distant third to Ethereum. Not a distant third, but a third place. It's been moving up very quickly. And I do believe, if I'm not mistaken, that who's the guy that owns the Dallas Mavericks? Why am I drawing blanks today? Whatever that guy is that owns the Dallas Mavericks, the eccentric billionaire that was on Shark Tank. I cannot remember his name right now. It's driving me nuts. I think he's actually backing Solana in some degree. So, well, I would say, for me personally, I think that it is competition because Brent says DOT is not competing with Ethereum. I think they are. You have parachains. You got, well, we go deep. There it is, Mark Cuban. For some reason, I could not think of that damn guy's name. Thank you. Katut says, I sold a put C at 63 expire next Friday. Okay, so Katut, so you sold a Citibank put? You got to be real careful with that one because Citibank, if my memory serves me right, Citibank comes out with earnings on Wednesday. Next week is the mother load of earnings season. It was dead this week. There literally is nothing going on this week earnings-wise that is of interest at all. Next week, you have every major bank coming out with earnings next week at JP Morgan, Goldman Sachs, Bank of America, Citigroup, Wells Fargo. All of these guys are rolling out earnings next week, and I believe Wednesday is Citigroup. So I'm assuming you probably got some decent premium for that, as selling going into an earnings week tends to be greater premium. But let's see what we got on Citigroup. No, it couldn't be Citigroup, Katut, because I'm looking at the chart right now. Citigroup is $67. You sold a 36 put expiring Friday. Well, you probably got, if you did, unless I'm reading this wrong, you got no money. Yes, Patrick. A put is when. Okay, there's two separate things here. You have puts and calls, right? Put is basically that you believe prices are going down. If you're buying the put, you believe prices are going down. If you're selling the put, you believe it's could go down to a certain point. And with each one of these, whether you're a buyer or a seller, there may be an obligation for you. So if you buy an options contract, you're under no obligations. If you are a seller of a call or a seller of a put, you have obligations that must be met if certain things happen. So they can be technically a little bit riskier, depending on which strategy you're using. But if you buy a put, you think things are going down, essentially. Let's see. Yes, it definitely has a different use case, Brendan. That's for sure. So Katut, if I look at the Citigroup, I will zoom out here and go to a weekly. I think you're probably fine at 36. If you're going weekly at 36 and you collected some premium, good for you. I mean, I'll take that bet that it's not going to get down to $36. Not even close. Even if they have really bad earnings, that'd be over almost a 50% drop from this point. So let me see, since my option chain is working, see if we can grab some option chains here real quick and just see what the premium is for, you said next Friday, Katut. Let me say, yep, that's all put expiring next Friday. So let me see if I got here. Let's go Citigroup. I'll bring it over here for you guys to see. All right, so there's your option chain. This is expiring next Friday. Yeah, so something I read wrong on this one, because there is no 36 option expiration on the weeklies for Citigroup right now. So it's got to be a different symbol. Plus, that's what I thought. You wouldn't get any premium anyway. You get 1 cent. All right, yeah. Shoot, if you made some money on that. There you go, 68. That sounds a lot better. Okay, so... yeah, 68 cents. 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 So basically, okay, so what Katut did, this is an interesting, very different strategy. So if you sold for next week, here is your 68 strike price. Basically what she's saying by selling the put is if it closes by next Friday anywhere below, if it closes at 67.99 or lower, then Katut will own Citigroup, right? She'll literally just deposit in her account. Now the challenge here is, what did she get for it? So I'm looking at the premiums right now, and I can show you over here. You guys can see the 68s. It says 138 to 141. Let's assume that she got $1.41 per contract. So if she looks at this one, I'll do two things. There's the 168, and then we'll add on what really is her true price. Because if you take $1.40 away from 68 bucks, you're left with 66.60. Right? So this second line is actually her average price. Now the challenge for anybody in that situation is, if Citigroup misses earnings or has a bad announcement next week, it could open up, let's say it gaps down and all of a sudden it's down here at like 60, right? Could it do that? Yeah, it could. You look at their last earnings, my guess is this is probably no, that can't be the last earnings, but this looks like probably an earnings announcement where we had a big gap up. If it gaps down to 60, you're going to own it at 68 and it would be currently at 60. So you'd be losing money on that one, and the challenge on that is you're still stuck with it until Friday. So if it gaps down on Wednesday, when I believe they report earnings, I think that might actually be Wednesday morning. If it gaps down big, you could be in pain for a couple of days here. It's a little bit risky on something going into earnings. That's the challenge. I definitely, if you are selling puts going into earnings, I like to do them way out of the money. Way out of the money, just because you get these extreme volatile swings. So for example, if I'm selling, maybe I'm looking to sell a put down at something like 50, 57.50, right? That's down near the bottom end of the zone. I wouldn't get anywhere near as much premium, but 57.50 right now, for a weekly only gives me 4 cents. Not worth it. Not worth it. So yeah, I'm not a huge fan of that one, Katut, to be honest, simply because you've got this company reporting earnings and you're right. It's a crapshoot. Yes, you got a decent amount of premium. It's just a little risky, a little too risky for me. Yes, Katut's in Indonesia. It's funny because I've been through Thailand, been to Cambodia, been to Nepal, been to Vietnam. I love Southeast Asia, but you have yet to go to Indonesia. Hopefully, one of these days I'll make it down there. All right. What last minute questions you guys got for me? You don't have to roll it. I'm just I definitely don't want it to deter you from whatever reasons you took that trade on. Just for me, it's a little risky selling in the money options when you're that close. I mean, right now, if this was going to expire today, you would own Citigroup at 68 bucks, and it's now below that. So a little bit risky. I would sell when it hits the strike price minus the credit received. Well, there you go. But Tom, it's a good point, but what if you can't? So, for example, there's the strike price is 68, credit received is $1.40, so you're saying I would sell if it got to 66.60. But remember, earnings can be so volatile. What if it all of a sudden opened at 55? You'd have no choice. You can't sell it at 66.60. It would never have touched it because it happened in the after-hour session because of a gap. You may get a lot of people to come visit you, Katut. I think most of us would love a holiday right now. I've got some of the holiday attire on right now. Brent says, Merlin, what is your favorite conservative income strategy? Selling puts. I would say selling puts, and I'll show some of that tomorrow. It's boring. It's not like amazing, great returns, but if you look at a % or more a month, that's not bad. And to me, it's about timing things, and if I can get maybe 2% on these options trades, then I feel more comfortable with that. Others would say go with spreads. I know we'll probably have Corey Lane in the program next week. He would say go with spread trades, but I like the selling of puts. It's always in something that I'm okay owning at specific strike prices. I think I told you, the ones I'm in right now. I've got SLV, which I'm probably going to do okay. I mean, those are going to expire in a couple of weeks here, and I got 2250s. The only one I'm nervous on right now is IWM. Right, you can see IWM has been pretty weak over the last couple of days, but my strike is 212. So I've got definitely a ways for it to drop in the next couple weeks. And then last one would be XLE. These are the three. I have others, but these are kind of the bigger positions. 48 is my average price, or my strikes on those. So when I wrote those was already like a week into the monthly contract. So it was like 1% for 3 weeks. I'm okay with that too. Do I ever sell naked puts? No, always cash secured. For me, always cash secured. OTS strategic investing is greater than 10% return. There's a lot of things you can do to help increase your rate of return. And we had this discussion with a couple. There was a question I think came in a few weeks ago from a viewer was saying, hey, I have all these shares, how can I sell options against it? And I'm like, you should be doing that, right? You should definitely be selling options. And I made one mistake because I was like, you should be selling calls, covered calls against those shares you have, put it at a price that's, you'd be happy getting out anyway, and then trail that stop up. And Tom was right. You can't put the trailing stop on a covered call because the covered call claims those positions, claims those shares. But you could, if price started to drop and went down to a psychological stop loss or a level you had it trailed at, you could buy back those covered calls and then close out your trade. So that's how you could do that. But yeah. Good. Control risk, man. It's the ultimate game. That's what it's all about. Merlin, are you looking at any Forex charts? Not really. I mean, I was looking at the Aussie dollar, and it's just simply not on the weekly. If you look at what's been happening, we've kind of been banging our head against this floor on the Aussie dollar, which I thought was appealing. USD CAD, also a similar picture, but more of an inverted cup and a cup and handle pattern. So this is one that I was probably the most interested in, just because the way this looks, it's no longer in this nice long downtrend line that you see on here, right? It's actually curling back up. New lows being put in, higher lows being put in, and there's actually today would have been a decent time to potentially jump on the USD CAD. If you're a little bit more conservative, that you go higher about that 126 and change mark, but it's looking better from a turnaround. Not really focusing too much on the euro right now until it gets a little bit lower. You can see we're coming towards that 117 mark on the euro, which I may be interested in that one. But right now it's just falling pretty quickly. I don't see anything that's going to stop that until we get to those March lows on the euro. British pound, haven't really been following the British pound. It's not really one that I normally trade. Euro and Canadian dollar and Aussie are my main ones. But look at it. GBP USD. This not bad. To me, this looks like a head and shoulders pattern or a potential head and shoulders. It's pretty weak, but it looks like it's about to roll over. And if you can get down below these levels here, which is about 136.80, a little bit less than that, you may be reversing this overall uptrend and headed down, much to the dismay of David Warner and Texas Trader Walker, or Walker Texas Trader. All right, let's see. What else do I got? Last minute ones. Transitory trade approved by USD. Let's see. What happens to your return on investment when you get a couple of 10 baggers or higher? It goes great, but you don't get when you're selling puts. You don't get 10 baggers, right? When you're selling them, you're not going to get the 10 bagger. It doesn't happen, right? It's just not going to happen. What's the difference between a naked put and a cash? Is not having the money to back it. Right, and again, to me, you can get over leveraged on some of these positions, but you have to have special permission to get. There's all these different 5 levels of trading permissions for options. In order to get to sell naked calls or puts, you gotta be a little bit higher up. All right, let's see. I put a note down since the option chain is officially working. So I'll try to do that 1% thing just to show you, just because I think it's a fairly conservative piece. I won't go into all the real nitty-gritty details, but just show you the basics of it. I'm a fan of it, and then maybe I'll do a show with Corey Lane next week, talking maybe comparison of, well, why would we do this versus maybe do spreads? And I'm sure Corey will win that argument because he's a way better spread trader than I am. So we'll have to wait for that one. All right, that's going to do it for me for today, guys. It is the 7th of July. Hard to believe things are moving that unbelievably quickly. If you have a topic for today's show or tomorrow's show, let me know. Jimenez, Lee, and Les, thank you for the questions. Hopefully those of you who are going to be bugged might be putting this one up here, but I added Les to the challenge. Les is walking 6 miles a day, reading 30 minutes, and an hour of trading-related education. So that'd be a good one for you to stick to. So me, Rob, Thomasina, and Les are the only 4 on here. Hopefully we'll get I'm going to go do some sit-ups right now. All right, guys, that'll do it for me. Hope you enjoyed it. Don't fear the inflation talk. Keep your eye on that 10-year because the trend right now is that it's drifting lower. We'll see how low that ends up going. I'm sure the Fed loves the fact that 10-year is dropping. It takes a little pressure off them. Hopefully, we will get some nice, exciting moves to talk about on tomorrow's show. So cool. Thank you so much. Again, if you have questions, comments, feedback, send it in at TraderMerlin@gmail.com or down below the YouTube video. I'll see you all tomorrow. Take care.